Hey everyone, welcome to the Polaris Energy Finance Podcast. I'm Terry Orumbold. Thanks for tuning in. If you're interested in where energy, mining, and finance collide, whether you're in the industry, learning it, or just curious, you're in the right place. This is episode 1. We'll be bringing on guests and having deeper conversations around energy, mining, capital markets. But today, we're starting with a market setup. We'll cover 3 things. First, how capital markets are reacting to recent shifts in energy and mining. Second, what's driving the current wave of M&A and the global context behind it. And 2 deal deep dives. The first one being the Alphabet Intersect one and the potential Rio Tinto and Glencore merger. Let's get into it. All right, starting off, let's talk money. Heading into 2026, energy and resources capital markets aren't really tightening, but they're resorting, if you will. AI-driven power demand, grid bottlenecks, and geopolitical supply chain realignments are forcing a repricing of risk. Now, it's a risk reallocation cycle, one that is rewarding scale, speed, and resilience. And, that shows up most clearly in M&A and platform formation, not necessarily greenfield development. Globally, if you look at it, capital really is abundant. Infrastructure funds, energy transition pensions, and sovereign wealth funds are sitting on roughly around 300 to 400 billion plus dollars of dry powder. That's earmarked for energy, power, and real assets. And on the clean tech and energy transition side, investments are expected to grow about 30% over the next 5 years, with incremental capital increasingly flowing east, particularly into Asia and China, where industrial policy, scale, and execution speed are aligning. So there's a bit of selectivity narrative going on here in the capital markets. Digging a deeper into it, equity investors are moving away from one-off projects towards platforms and portfolios, and one can see that repeatability beats really like bespoke risk, right? Pure growth narratives are fading, and the dominant equity thesis now is yield plus growth, and cash flow today with strategic upside tomorrow. So what about debt? Well, debt still anchors energy finance, but only until physics intervenes. So for contracted renewables and grid-linked assets, 60 to 75% leverage is still achievable with long tenor amortizing debt available. But the overall underwriting has changed a bit. Now, lenders aren't just like credit rating counterparties anymore, right? They're explicitly pricing transmission access, congestion, interconnection queue risk, merchant tail exposure, and nodal volatility. Oh, speaking of transmission and interconnection, let's go through some insights from S&P Global Energy Research, starting off with data centers. Global data center electricity demand is projected to grow about 17% annually through 2026 and 14% annually through 2030, reaching roughly around 2,200 terawatt hours, which is about the current electricity consumption of India. Now, in the US alone, data center capex is approaching $500 billion by 2026. Moving on to another continent, in Europe, roughly 40% of grids are over 40 years old. Investment needs are estimated at 584 billion euros by 2030, rising to about, get this, 1.2 trillion euros by 2040, while transmission permitting timelines are stretching from 12 to 17 years. In the US, data center growth is overwhelming legacy local grids, and grid modernization is now framed as a national competitiveness issue. Now, as a result, capital is concentrating around brownfield upgrades, grid adjacent generation, storage, and flexibility assets. Against this backdrop, M&A has become the fastest way to buy certainty. In 2025, Global energy, utilities, and resources M&A deal value rose by around 27%. Even as deal volumes dipped, it's a classical signal of top-end consolidation. So, three structural forces are pushing deal making into 2026. First, AI has triggered a structural reevaluation of assets with secured access to power, fuels, grids, and minerals. And operating and near term assets now trade at a premium because time to power is a financial variable. Second, the scale of required investment is accelerating consortium capital and hybrid platforms. Deals increasingly blend private equity, sovereign capital, private credit, and strategic corporates, really aligning long duration capital with operational capability and demand certainty. And this is becoming the default model for large cross border transactions. Third, private credit has become a central deal enabler, right? Valuation gaps, policy uncertainty, and capital intensity are keeping flexible credit structures at the core of take privates, carve outs, and continuation vehicles, and really just all capital heavy infrastructure deals, even as lenders get more selective. In energy and mining, companies are drawing from the same global capital pool, right? But they're under different rules. Copper, in particular, has become the focal point, reflecting both structural constraint and its role as the physical backbone of electrification and the digital infrastructure. And we'll deep dive into it when we're talking about the Rio Tinto and Glencore deal as well. So, all in all, this M&A wave really isn't de-stress driven. Buying scale is faster and increasingly cheaper on a risk adjusted basis. All right, now that we covered what's happening in the market, let's talk about some deals now. In December 2025, so just a month ago, Alphabet, Google's parent company, announced that it is acquiring Intersect for $4.75 billion. It is a vertical integration transaction and one of the clearest signals yet that hyperscalers are restructuring how power gets financed in the US. Intersect brings $15 billion of operating and under construction infrastructure, 10.8 gigawatts of clean energy capacity expected to be online or under construction by 2028, a development pipeline concentrated in Texas and California, two of the most grid-constrained data center-heavy markets in the country. Alphabet is acquiring the project that directly emerged from its prior partnership with the company, with Intersect, including 3.6 gigawatts of solar and wind, 3.1 gigawatt hours of battery storage, and a co-located data center load. So this really isn't an opportunistic M&A. It is a monetization of a multi-year $20 billion of joint development strategy. All right, some history lesson here. Historically, Google, or really like any of the large tech companies, are usually an off-taker, right? They sign long-term power purchase agreements, and developers or like operators would own the assets and the bank would finance the risks. And this Google or the Alphabet Intersect deal really is kind of collapsing that triangle. And beyond the surface level, what Alphabet actually just bought is that it really didn't just buy generation, it bought development optionality for its generation assets, interconnection queue position, transmission adjacency, and timing control relative to its own data center load. So really Alphabet is moving up the value chain from being a contracted customer to now a platform owner. Kudos. Here's the part developers and investors may need to internalize: that Alphabet's cost of capital is just structurally lower than any standalone renewable developers, right? Alphabet can finance power assets using its own corporate balance sheet debt, internal cash generation, and strategic hurdle rates, which are not infrastructure fund IRRs. So returns really don't need to clear a 12 to 15% equity hurdle. They just need to de-risk the power supply and lower long-term marginal energy cost and protect Alphabet's or Google's AI and cloud margins. And that's a fundamentally different underwriting lens. So what's happening in the operations aspect of it though? So Alphabet is keeping Intersect operationally independent with its CEO and team intact. So that matters, right? It preserves developer speed, execution culture, and credibility with regulators, utilities, and community. So everything that Intersect was known for before Alphabet acquired it, hopefully it gets preserved as the operations are kept independent. At the same time, Alphabet gains control rights over critical projects without really fully internalizing developer bureaucracy. And this is a classic sponsor behavior and really not a corporate vanity. There's another important signal in this deal as well. Intersect's operating assets are being carved out and sold to an investor-led vehicle backed by TPG, Rise Climate, and other infrastructure investors. So, to put it in simple terms, Alphabet is keeping development stage and load linked assets, and financial investors keep de risked cash flowing infrastructure. So they're doing like a textbook value segmentation there. And Alphabet wants control and flexibility, and infrastructure funds want yield and stability. The reason why this deal is interesting is because of the grid being a binding constraint right now. Alphabet has been very explicit about one thing, which is that AI is now constrained by the US power system. And data centers need always on power, predictable pricing, physical proximity to generation and transmission. So signing PPAs alone really don't solve these issues, but owning generation and shaping where it gets built, especially as a hyperscaler or a tech company, could solve this issue. All right. Should developers be worried? That's hard to tell, right? It really is just like a signal or an instance. So for developers, hyperscalers may not just be customers anymore. They can now be competitors for sites, buyers of late stage pipelines, and potential code developers, even. So development margins could compress hypothetically, but on the other hand, exit certainly improves there. Alphabet acquiring Intersect tells us that fundamentals about where energy finance is heading. Energy assets are no longer just yield instruments, they are becoming very strategic inputs into AI, cloud, and national competitiveness. So the question for investors is no longer will tech vertically integrate into energy, but it's more like how do you position capital when your former off-taker becomes the sponsor. Continuing on, in the mining sector, we're hearing chatters about a potential merger between Rio Tinto and Glencore. So, a merger between these two giants would create the largest copper producer in the world, with an enterprise value north of $260 billion, at a moment when copper demand is accelerating much faster than supply can respond. Let's start with some deal logic here. A combined Rio Glencore entity would produce more than 7% of globally mined copper by 2026, according to Benchmark Mineral Intelligence. So, for context, right, the planned Anglo American tech merger, which was announced late 2025, it would get you 4% of global copper. And copper prices are up 40% year on year, and S&P Global projects copper demand up by 50% by 2040 and a potential 10 million ton annual supply shortfall by then. That is the macro backdrop underwriting this conversation between the two mining giants. So, why copper and why now? Everyone wants to be in copper, and shareholders are increasingly supportive of growth in copper specifically. And really, copper has moved from being an industrial input, we used to call it Dr. Copper, to signal us the health of global economy, but it really shifted from being an industrial input to being now an strategic infrastructure almost. And really, copper is used in. You don't really have to have me tell you this, but copper really, is used in electrification, transmission lines, renewables, EVs, increasingly data centers, and used also for defense technologies. The reason these mining majors are consolidating isn't because synergies are easy. It's because building new mines is hard. Greenfield copper projects take 10 to 15 years to permit and build, face rising energy and labor costs, and are dealing with declining ore grades and increasing political risk, right? So acquiring copper in the ground, especially tier one, long life assets, is increasingly the only scalable option. And speaking from a personal experience, I've worked for Rio's copper mine in southern Mongolia, and the sheer scale of that operation is amazing. And then also just like setting that up to that scale takes a lot of time. So it really makes sense this deal from a person who's also worked in mining on the ground on site as well. Um, so now let's discuss what each side brings to the table. So Rio is bringing tier one copper assets, long reserve lives, and balance sheet discipline and operational credibility as a mining giant. And Rio is targeting 1 million tons of copper production per year by the end of the decade, up from 700,000 tons in 2024. So a really big production projections going up there. So a big producer of copper. Now Glencore brings a copper-heavy capital allocation strategy, vertical integration through its trading arm, which is very interesting, especially for the merger, and exposure to critical battery metals other than copper. So copper represented nearly half of Glencore's industrial capex in 2024, despite accounting for only about a quarter of revenue. So you can see there's a lot of spending going on there, and emphasized importance on copper from Glencore's perspective. And that tells you where management believes long-term value lies. So really, copper is the headline here, but it's not the only prize. Glencore is the world's second largest cobalt producer, largely as a byproduct of copper and nickel mining in the DRC, Australia, and North America. Rio, meanwhile, has been quietly building its own lithium platform, especially with their acquisition of Arcadium Lithium for about $6.7 billion in 2025. And they're also targeting 200,000 tons of lithium carbonate by 2028, which is up from 60,000 tons today. So both giants are strategically positioned to future-proof portfolios around electrification and storage. And if Rio were to pay a premium for Glencore, it wouldn't be for near-term earning accretion, right? It would be for a strategic premium. So for copper optionality, for reserve life, and for relevance in a post-iron ore centric world. And iron ore cash flows still matter, but iron ore alone doesn't define the next decade, but copper does. So the conversation comes immediately after the Anglo-American tech mega merger, and before that, BHP's failed bid for Anglo in 2024 was really the starting gun, one could say. So what we're now seeing is that natural combinations could be resurfacing, especially in the industry, and major mining companies are repositioning towards future-facing minerals, and capital markets are rewarding scale where scale controls scarcity, especially in our modern fragmented world or more fragmenting world. And as you know, we talked about it in the capital markets overview earlier in the podcast. Now, after a Rio Glencore tie up, there might not be much left at the very top. The next wave likely comes down the curve into the second tier. The real question isn't whether copper demand will grow. That debate is over. That debate was over yesterday. The question is who controls enough supply to matter and who gets, unfortunately, priced out. A potential Rio Glencore merger is signaling that mining is entering really like a consolidation phase that is driven by scarcity. And, it is evident that capital is after control, longevity, and strategic relevance in a world, okay, no pun intended, rewired with copper. Whether this closes or not, copper is the most investable metal of the cycle, and the race is on. That's it for episode 1 of Polaris Energy Finance Podcast. If this episode helped you think more clearly about energy and mining, share it with someone who's trying to break into the space. I'll be bringing on guests soon, investors, developers, my professors even, and industry experts, but I'll also keep doing solo episodes like this when the markets move. Thank you for listening to Polaris Energy Podcast. See you in our next episode.